Good morning. It's Wednesday, the 11th of December, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. We don't have a take for today too, but we have lots of reports and conversations and fairly important ones. And the top themes and stories for the day. The markets are flat as flat goes. The rupee hits a fresh low on expectation of interest rate cuts. What does the new Reserve Bank of India Governor bring to the table, and what does he leave behind? Why are clothing manufacturers protesting a potential goods and services tax hike? The IATA projects record $1 trillion revenues for the aviation industry with over 5 billion passengers and 40 million flights in 2025. And more chaos on the streets, Amazon dives into 15-minute delivery too.
This is a core report with Govindraj Ethiraj.
And the markets are flat again. There was nearly nothing to fire up the stock markets or send them down, in keeping with the theme of vanishing cues that we pointed out on Monday. The main indices, that's the BSE Sensex and NSE Nifty50, ended Tuesday's swinging session once again flat. The 30-share Sensex closed at 81,510, up by 1.59 points. I repeat, less than 2 points. Similarly, on the NSE, that's the National Stock Exchange, the Nifty50 settled or closed at 24,610, down 8.9 points or less than 9 points from its previous close. The broader markets were stronger, with the Nifty Mid-Cap 100 and Nifty Small-Cap 100 ending higher by about 0.2% or so. There is other news on flows which could impact markets, so it's too early to say which way right now, since the trends might shift again. Equity mutual funds saw inflows of 35,900 crores, or close to 36,000 crores in November, which is of course not a small number, but that's a 14% drop on a month-on-month basis. At this level though, or rather even then, it was still the 45th consecutive month of net inflows into equity-oriented funds, reflecting of course the growing popularity of mutual funds, which continues to stay, according to data from the Association of Mutual Funds of India released on Tuesday and reported by the Business Standard. The reasons are the overall volatility and, of course, the US elections and the outcomes, including on markets. Overall, the mutual fund industry has seen an inflow of about 60,000 crore rupees in the month under review, as compared to 240,000 crores in October. So if you look at the aggregate numbers, it's a pretty sharp drop in November. But let's see. Despite the decline, the industry's net assets under management rose to about 68 trillion rupees from about 67 trillion rupees in October. The markets are getting more efficient. Meanwhile, the Indian stock markets took another step towards greater efficiency and settlements, as the Securities and Exchange Board of India on Tuesday said that the top 500 stocks will be eligible for the same-day settlement cycle, or T+0, in a phased manner. This move is seen as a fresh push to ready the market ecosystem to speed up the settlement cycle, which currently stands at T+1, which is trading day, or on the day the trade takes place, plus another day. The wider eligibility will become effective on January 31st, 2025. The same-day settlement cycle will continue to be optional, the Business Standard reported, adding that only 25 stocks are available for T+0 settlement right now. The beta version of the settlement cycle was launched in March this year, though the response apparently has just been okay, with no significant volumes. SEBI said that scrips will be available for trading and settlement, starting with scrips at the bottom 100 companies and gradually include the next bottom 100 companies every month until the top 500 are available for trading in the optional T+0 settlement cycle. Stockbrokers could also be allowed, or will be allowed rather, to charge a differential brokerage for this facility. SEBI's also announced a block deal window from 8:45 a.m. to 9 a.m. for the T+0 settlement cycle, in addition to the existing block deal windows for the T+1 settlement. And SEBI has also proposed simplification of the process for non-resident Indians to trade in exchange-traded derivatives contracts. They are currently required to obtain a custodial participant code, or CP, from the clearing corporation through a clearing member. Under the proposed changes, NRIs can use their permanent account number issued by the Income Tax Department, or PAN, to monitor position limits and can then deal with multiple clearing members, or CMs. All of this is expected to ease investment for NRIs and simplify the procedure for monitoring NRI position limits, for those who are monitoring them, that is, and of course bring in more dollars, something India is always looking for. Speaking of dollars, the rupee has slipped to a record low and government bond yields fell on Tuesday after the appointment of Sanjay Malhotra, Revenue Secretary of the Government of India, as the next governor of the Reserve Bank of India. That happens today, and this has prompted traders to ramp up bets on rate cuts, according to Reuters. So the rupee hit a low of 84 rupees 85 paise against the US dollar before closing at 84 rupees 85, down 0.1% on the day. So the changes were in the third and fourth decimal point. Government bond yields dipped while the 5-year overnight index swap, a gauge of interest rate expectations, declined to a 3-month low of about 5.9%. And the 10-year bond yield fell about 2 basis points to 6.69% during the day, according to Reuters. India set for resilient growth, says S&P. S&P Global Ratings on Tuesday said the Indian economy is set for resilient growth in 2025 and projected inflation pressure to recede, which could lead to modest easing of the monetary policy by the Reserve Bank. In its India outlook for 2025, S&P also retained India's growth forecast for the current year at 6.8%, followed by 6.9% next year, that's 25-26, the financial year. The economist at S&P Global Ratings, quoted in Business Standard, said that the Indian economy is set for resilient growth in 2025 on the back of strong urban consumption, steady service sector growth, and ongoing investment in infrastructure. He also said they expected the central bank to ease monetary policy modestly during 2025 as inflationary pressures recede. India's economy grew about 8.2% last year, that's 23-24. S&P says there are various challenges for the economy, including post-pandemic weakness in the public sector and household balance sheets, a highly competitive global manufacturing environment, and weak agriculture sector growth. Creating enough jobs for India's high labor force participation, further infrastructure and technology improvement, and stronger public and household balance sheets could support economic growth, S&P's economist has said. The new governor, what does he bring? Will the new governor, Sanjay Malhotra, who begins his 3-year innings at the Mint Street on December 11th, that's today, cut rates sooner than expected? Well, that is the key expectation going in now, though that expectation seems a little higher than expected and would suggest that the previous governor, Shaktikanta Das, was really resisting a cut. Meanwhile, a new Reserve Bank of India deputy governor is also expected to come in because a current deputy governor, that's Dr. Michael Patra's term, ends on the 15th of January. Brokerages quoted by the Business Standard say that a high real policy rate and softening growth could create room for the Reserve Bank to lower the repo rate by 75 basis points starting February 25. Some brokerages also pointed out the divide between the government and the Reserve Bank on the need for counter-cyclical monetary policy, with both the Finance Minister and the Commerce Minister pointing out that the Reserve Bank of India was keeping policy tight on account of high inflation in a few food items. And this, of course, happened, which is the interest rates were retained or kept the same in its latest meet on December 6th. Sanjay Malhotra, the new governor, of course, comes in at an interesting time for the Reserve Bank of India and somewhat suddenly, rather, since the appointment was last moment. He also leaves a void which will not be easy to fill at this critical juncture and once again highlights the perils of delays in key appointments. I reached out to Ashok K Bhattacharya, Business Standard Editorial Director and columnist in the newspaper in New Delhi, and I began by asking him what the new governor who takes charge today was looking at and what were the tasks before him.
Remember that he is probably the first revenue secretary who is joining the RBI as the governor. Of course, he has had a very short stint with the Financial Services Department, which meant he dealt with public sector banks and the financial sector to some extent. So he is no stranger to issues that are relevant for the financial sector. But he's obviously new. But his first task, in my opinion, would be to decide on the composition of the Monetary Policy Committee, the key appointment of the deputy governor who looks after the monetary policy. That appointment is due now. Now, he as a governor will have to decide whether he wants to get an economist who can succeed Dr. Michael Patra, who provided the support and the kind of, there was almost like the backbone of Shaktikant Das's economic monetary policy formulation. So he will have to get hold of a person who can be part of that monetary policy committee as a deputy governor. So I think that will be his first big task. And of course, he is joining the RBI at a time when there are not just the pressures of inflation management. Remember, RBI is an inflation targeting bank. And of course, he has to take care of growth. And then there are subsidiary issues of currency management. There are issues about what he does with the cyber security issues. There are questions about banks lending to the system at a time when economic growth needs to be revived. So a host of issues will stare at him. So he is going to have his plates full.
What would you say is, let's say, the one key unfinished agenda of his predecessor, that's Shaktikanta Das, from in your opinion or an understanding?
Well, one unfinished task was Shaktikant Das's initiative on the unified lending interface. He had just started it because in terms of financial inclusion, the UPI, Unified Payment Interface, was creating sort of democratization in terms of the payment architecture. And Shaktikant Das wanted to introduce a similar architecture on the lending space. So I think that project is yet to be launched in its entirety. Work has begun. That, to my mind, is an unfinished agenda. And number two would be, how does he combine the Reserve Bank of India's objectives of inflation control without dampening growth stimulus?
So, do you see this Reserve Bank of India governor being friendlier to the government than previous Reserve Bank of India governors in any way? Or are all Reserve Bank of India governors who come from the government, mostly Ministry of Finance, equally friendly and therefore tend to do what the government wants?
I think once you become the RBI governor, the RBI system also influences you a lot. So you may come as an IAS officer, you may come from the finance ministry, but once you are at Mint Road, my experience tells me that whoever is the RBI governor, he starts looking at the system, the monetary system, the fiscal system even, from monetary point of view, from a financial sector stability point of view. So I would not look at an RBI governor through the prism of whether he's friendly to the government or not. Yes, the points of friction may be less, and whatever points of friction may arise, they will not be played out as a public spectacle, but they will be sorted out within a room in meetings. So that is what you can definitely assure if you have an IAS officer as the governor. There are very rare instances of a civil servant governor of the RBI fighting a battle with the government out in the open. There are a few, but there are very few.
Got it. And I mean, just a small sort of almost digression of a question. Do you think that, we did see Raghuram Rajan who came in from the outside, so to speak. Do you think the Reserve Bank of India needs or different interventions like that in the form of people who come from outside and from a slightly different world? Although, of course, they would be conversant with macroeconomic policy and monetary economics and so on.
I think any government needs a bench strength of technocrats, economists, whether they become the RBI governors or the chief economic advisors or even the economic advisors to the prime minister. So I would say that Reserve Bank of India also needs a fair share of that, such people who understand economic policy making to the core. It is not always necessary to have an RBI governor who is an economist, but it is always necessary to have at least a few top-notch economic policymakers, economists with the economist minds space, to be part of that team, particularly when you have monetary policy committee where the RBI representation has to be at least 3, which is governor and 2 more persons. So those deputy governors and maybe the executive director will have to bring onto the table strong economic thinking. So even if you have an RBI governor who is not trained in economics as such, but he can then they play the role that is expected of the RBI governor.
Let's talk about the Ministry of Finance for a bit. So the Revenue Secretary and now Reserve Bank of India Governor has obviously left a bit of a hole there now in that team. So what is the implication of that?
Well, the immediate implication is that the Finance Ministry has to find Revenue Secretary because, in the core budget team, Revenue Secretary plays a key role in tax formation. And given the fact that Mr. Sanjay Malhotra did play a major role even in the last budget, particularly on the capital gains taxation reforms and etc., etc., So I would say that the first task for the government, the finance ministry, would be to fill that gap. Budget is on us, less than a month and a half to go. So for that is something that has to be addressed with immediate effect.
You've argued in the past that this team that the finance minister Nirmala Sitharaman has had with her in the last couple of years is a good one and supported her well.
I would say till about early this year, when Dr. T.V. Somanathan joined the finance ministry, under him, with the support of the finance minister, you saw a very strong team of bureaucrats providing support, direction, and a right trajectory to fiscal policy making and budget making. But what I see now is that after Dr. Somanathan's exit from the finance ministry, you have a new team in the making. Dr. Govil is there as the expenditure secretary. You have Tuhin Kanta Pandya, who is a disinvestment. He's a public sector department, but he's the finance secretary. And you have Ajay Seth, and now Sanjay Malhotra is leaving. So I think there's a transition stage. A new team is in the making. As long as Dr. Somanathan was there, he kept the team intact and very, very focused. But I see some sort of a flux the last few months. And I guess this is a matter of time, because given the fact that Nirmala Sitharaman functions in a very collegial spirit with her top secretarial team, I would say that it's only a matter of time when you see a new team having emerged in the next couple of weeks.
I'm also concluding or trying to read between the lines that there is a cost then of a good team dissipating, which of course happens in government, but at this point of time, at least from the budgetary process, and the time it will take for a new team to break in and get going.
Govind, there is no doubt that this decision should have been taken at least 3 months ago. There is no reason to take a decision on who will be your next governor at RBI just a day before his extended term ends. So clearly the government was thinking in more than one direction, and that is a cost that I would say the government and the system will incur to some extent. That when you take a decision with only 1 day to spare, you take these decisions where you have to pluck out the revenue secretary because you think that he is the best choice. But then it creates a hole, very, very big hole at a time when budget is to be made. So if only the government has taken a decision 3 months ago that we don't want to give an extension to Mr. Shaktikanta Das. So the search and the selection process would have begun in good time, and you wouldn't have seen the budget team being disturbed. What I worry from this appointment, not that an IS officer has gone as the RBI governor, but what I do worry is that because of these appointments at this point in time, your budget team is slightly been disturbed.
Right. AKB, it was a pleasure speaking with you. Thank you so much for joining me.
Thank you for having me.
Air travel is rocking and revenues to cross $1 trillion. The International Air Transport Association, IATA, has said there is a strengthening of profitability amidst ongoing cost and supply chain challenges in 2025. Importantly, total industry revenues are expected to cross $1 trillion. That is an increase of about 4.5% from 2024. That's the current year, and will be the first time that industry revenues cross that $1 trillion mark, which is almost 1% of the global economy. Passenger numbers are expected to cross 5 billion in 2025, which is also about 6.5% more than last year, or rather this year, 2024. And this is the first time that the number of passengers is crossing the 5 billion mark, and this will happen over 40 million flights. According to Willie Walsh, IATA's Director General, while $1 trillion is a lot, it also makes airlines a strategically important industry, but he also points out that airlines carry about $940 billion in costs, not to mention interest and taxes, and they have a very low net profit margin. And therefore, when margins are so thin, which is less than 4%, airlines must continue to watch every cost and insist on similar efficiency across the supply chain, including from the monopoly infrastructure suppliers who all too often let us down on performance and efficiency, according to Walsh. On the other hand, IATA highlights the broad benefits of growing connectivity. The most recent estimates show that airline employment is expected to grow to 3.3 million in 2025. But you have to remember that airlines are at the core of a global aviation value chain that employs almost 86 million people and generates about $4 trillion in economic impact, or almost 4% of global GDP, according to IATA. Of that 1 trillion, passenger revenues are expected to reach about $705 billion, or 70% of total revenue, and about $145 billion from ancillary services to come in. The other point, if you are still interested, the average airfare in 2025, including ancillaries, is expected to be about $380, which is lower than 2024, though only about 2%. But in real terms, adjusted for inflation, IATA says this represents a 44% drop compared to 2014, and therefore there is a lot of value to consumers at this time. And IATA's public opinion polling also confirms an optimistic outlook for passenger demand. It says that 41% of surveyed travelers said they expect to travel more, 53% the same frequency, and only 5% expected to travel less in 2025. And 47% of travelers said they expected to spend more on travel, 46% expected travel expenditure to remain the same, 8% expected to spend less. Meanwhile, CNBC reports, quoting UN Tourism, that the global travel industry is set to fully recover from the COVID-19 pandemic this month. During the first 9 months of 2024, international arrivals worldwide reached about 98% of pre-pandemic levels compared to that same period in 2019. So the remaining 2% gap will close this month, according to the organization, and this would mark a momentous shift into a new era of growth. Most regions around the world have already crossed that threshold, according to UN Tourism, most notably in the Middle East, where international travel arrivals were up almost 30% in the first 9 months of 2024 from the same period in 2019. Africa and Europe have also recovered, says UN Tourism. The clothing manufacturers are protesting a GST hike rate. The Clothing Manufacturers Association of India has protested a potential increase in goods and service tax on apparel sold in the country and has said that the impact could be significant and cause some 100,000 jobs to be lost. The CMAI also said that high taxes would hurt legitimate retailers and potentially benefit unscrupulous sellers and illegal merchants. The group of ministers had recommended a GST rate rationalization which would increase GST on garments priced between 1,500 rupees and up to 10,000 rupees to 18%. It also recommended increasing GST on garments priced above 10,000 rupees to 28%, while garments priced up to 1,500 rupees will be still taxed at 5%. So this is all quite complex, and so is the impact. I reached out to Santosh Katariya, president of the CMAI, who is based in Pune, and I began by asking him why the impact of that proposed GST rate hike would be so high on his industry.
Proposal which has been laid by the Deputy Chief Minister, Mr. Samrat Chaudhary. So he has proposed that GST for 5% till 1,500 and above the 1,500, straight away it is to 18%. So basically, just to let you know, means the garment worth rupees 1,499 will attract a duty of 5%. Okay? And just 100 rupees above, a garment worth rupees 1,599 will attract a duty of 18%. See, the difference between just 100 rupees and a difference of 18% and 5%, which is not a justifiable. Okay? And another thing, basically they are thinking that it is a luxury, but nowadays above 1,500 till 10,000. Yes, definitely above 10,000, definitely you can say a luxury. But above 1,500, it is not a luxury. So, and basically the major industry is running between this price segment from 1,500 to say about 5,000 rupees. This is the mid-segment area where the maximum business is happening. So definitely formal business, okay, this will be definitely going to ruin the entire business, and another illegal things may get start again.
Got it. If you can tell me, what is the composition of the industry? Like, for example, when you say let's say most of the industry is producing at this, in value terms, I mean, what is the breakup today between how much roughly of the industry is, let's say, in the lower segment in value terms versus, let's say, more than 10,000 rupees?
See, if you are talking about, say about a wedding, okay, so lower spenders is 17%, lower middle is around 29%, somewhere around, and middle is around 51%, okay, and high spender and elite class is around 2% only.
When you say that, there many jobs could be lost, why is that? I mean, you're saying that because the industry will not be able to absorb the higher cost or the consumer will not be able to absorb it?
Because see, our garment industry is completely coming under the Legal Metrology Act. Okay, so MRP is compulsory. If you look at any other some industry, like suppose you go to hotel industry, so price band is fixed and whatever you are charging above the price GST. But in garment, MRP is included for GST. So definitely right now the entire industry, this mid-size industry is working up net PAT margin. If you are talking about very thin margin, around 1 to 3% is a PAT. Okay, if you look at the financials. Okay? So if any producer or any manufacturer will definitely feel very unhappy with increasing his MRP, because he will be definitely worried for whether my garment will sell it or not at this price. So definitely this price hike, and another, the major thing is that the entire industry working around a credit period of 3 to 4 months, and GST component you have to pay to the government very much in the 1st to 5th in the next month. So definitely there will be a very, very huge shortage of working capital. Right now already industry is facing too much of working capital. 2 million viewers is definitely a vital part of India's heritage. Okay, and this high cost of production, most of these products will fall in around 18% GST bracket, and large portion, in fact, in the 28% slab. The artisans may further face a 25% income loss, besides already struggling to keep their age-old craft alive due to limited market access and traditional business model. The proposed rate would tax these heritage products at a considered very seen at a rate till now.
Right. This is a general question, Santosh. So what is your sense of demand right now? I mean, how are you in the last few months, or at least, let's say, the last 6 months? How has demand been overall for for clothing, for textiles, for garments, and so on, from the consumer side?
Basically, demand is not increased at a very high this thing. Okay, so demand is constant, but people are definitely looking at very much price sensitive. So before you can say that before COVID, most of the garments are going to be sold in a fresh season. Okay, but after COVID, the USS period still has gone up. It means people are looking at discounts because they are not going to afford the fresh prices. So definitely every brand is worried about whether their fresh sales will go down, and again discounts is go up. Definitely it will affect drastically in their margins.
Santosh, thank you so much for joining me.
Yeah.
Prepare for more traffic nightmares. So, do expect more traffic chaos as Amazon too joins the 15-minute delivery race to satiate the appetites of the millions of time-poor Indians who are unable to plan their lives even a day ahead, and thus will remember what they want only 15 minutes before they actually want it. Thankfully, this will only be in Bangalore to start with, but rest assured it will spread to other cities as well. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.